What's going on, everybody? What's up? These sideways days are just so much fun. But at least it's doing what we had anticipated that it was going to do, right? At 7:30 this morning when we ran the morning briefing, tried to define what kind of day today would be. The base case estimate was, unless we saw some outsized news, it would probably just be another sideways day while we wait for Jackson Hole. So yay, at least we got that. But otherwise, it's kind of boring. The whole market is waiting on this, and so while it's always a stock pickers market, we can go in and individually find a few things to trade for the indexes. There's really not much joy holding that half 63.74 for the SES. I don't know if you guys have any particular topics you want to cover. I don't, not really. I shared some day trading videos in the chat yesterday. It seemed like it would fit well with the conversation that was going on. Those videos tie into the idea of approaching day trading a little bit differently. Right? It's most of the reason I made them is most of the videos that I find, they focus on, oh, some indicator or a particular scan, some price pattern. But these videos, specifically designed for options, go into the more nuanced things like bid ask on the options chain, what strike, what expiry, because those are questions that I see a lot of traders get hung up on when they're trading options, not knowing what strike to trade or what option to trade, how far out in time to go, how deep in or out of the money to go. So that's what those videos really focus on. When it comes to day trading options, there's a bit of a handicap. Um, and a lot of research has gone into this, not just by me, but I mean, all over, right? Uh, The whole idea of day trading options, if we set aside the fact that it's options at all, and we just think about trying to day trade, say anything, stocks, options, futures, then you're hung up with the idea that you're trying to get a price move and that the farther it goes, the more money you make, unless you're selling options, which I mean, that's why so many people sell options on intraday basis, is because you don't need price to go anywhere. Makes it a lot easier to be profitable. But if you're buying options on the intraday, getting hung up on the profit targets, how far it can go, really you want to circle back and focus on the particular stock, because each stock has an average move to it. Tesla moves farther than SPY, for an example. Meta moves less than Tesla, but more than Google, right? You can run a check and see, hey, how far does a particular stock move on a day to day basis? Some people use ATR. I like ADR, but you can just look at the average daily range of a particular stock and get a feel. There is something else that you can use. It's called beta. this gets to be a little more complicated, especially if you're going to focus on things like commodities or volatility products like the VIX. But in the options chain over here on the far right is what they call fast beta. I think there's a slow beta too, but just focus on fast beta. And you can change this setting in Thinkorswim if you go to like the setup menu and you dig through the menu in there. You can change fast to slow. But beta is a calculation of the thing that you want to look at and compare it to, you know, what, that's that's right. I shared it at one place. I didn't share it at the other. It would help if you guys could see it, huh? How about that? So what we're looking at is the S&P on the options chain, and in the upper right corner is fast beta. It's under underlying. So if we click that drop down, got fast beta here. Now, since I'm on SPY, it says 1.0. If I go to anything else, it will compare that thing that I'm looking at to SPY, and it's going to ask the question, how much further do you move than SPY on a day-to-day basis in percent terms? Like I said, that's a little more confusing than just an ADR. But for an example, if we go to Google, and if I wanted to know how much further Google moves in a 1% move than SPY, fast beta is 1.09. So if SPY moves 1%, excuse me, I need to quit saying points. If SPY moves 1%, Google would move 1.9% on average. So if you're trying to find things that really run, you can go into the scanner and run a fast beta search and look for things with like a 1.5, 2.0. If we look at something a little smaller, like Joby's a $14.50 stock. It's kind of cheap, and it has a fast beta of 2. So if SPY moves 1% today, Joby is likely to make a 2% move today. So that's beta. That becomes helpful when you're trying to day trade especially in options, since a lot of us are buying to open and we will make money when price moves. We won't make money if it's not really a mover. But getting hung up where a lot of people do is, well, which strike should I choose? And what expiration should I choose? And how much money should I risk? How much money do I think I can get? Now, I covered this topic in those videos, but I'm going to run it through real fast here because you can always just watch those replays later. I call this strike price shift differential. It's a real big fancy name. If I had another word for it, I would just use that, but I don't. So if I was to buy this 14 strike call, and we're going to buy it on the ask, so we're going to pay $1 for it, how much could I conceivably get if the stock moves 50 cents? Any ideas? We should get 25 cents. Well, that's the ugliest circle I've ever seen. So we should get 25 cents because if we move one strike up, that's how much it's worth. It's telling us that in advance. I know it says with the delta of 65 that we would make 65, but that's for a $1 move. And this is for a 50-cent move. If we did look up 2 strikes, which is a $1 move from 14 up to 13, there's our 65 cents because it's the 65 delta being applied to a $1 option, and now it's worth $1.65. That's pretty easy because it was a $1 option and it's a pretty cheap stock, and the math is simple. It's a lot harder if it's bigger numbers and maybe $5 wide on the strikes, right? Like if we go over to the SPX, now the numbers are going to be a little more complicated. So out here, if we're looking at 63.75 and I was going to buy that option, if we move $5, how much am I supposed to make, or could I expect to make in that move? Strike price shift differential says I'll make that much on the sell. And if I'm wrong and I start to lose, I could use a $5 price stop, look to get out if it goes against me around $5, and I could sell it for this. So if I bought it for 59.80 and I sell it for 56.80, then I lost $3. Notice I rounded there. I rounded there because if you're in a hurry and you're day trading, you can't sit there with a calculator trying to just type it all out, right? You need to be able to run it quick on the fly. So round your numbers. And I show all that in the video. It's what I do as a day trader. When I was trading options constantly in the daytime, which I don't day trade options as much now, but the technique is still there. You got to be able to run things fast on the fly. So 60 flat against 63. So if we go up, I'll make $3. If we go down, it'll be less than that right now. From 60 to 56 and a half, $3.50, $2.50, excuse me. So if I'm right, I make 3. If I'm wrong, I lose 2.5. And I can see that really quick just at a glance using a $5 profit target or a $5 stop. And that's a $5 price stop, right? We're talking about getting in at 63.75 and running it to 63.80 to make $3, or staying in it until we get to 63, 60, whatever it was, 66.50, and then get out, right? That helps you be able to answer the question, how much money should I expect to make in this trade? One thing that I found really hard as a day trader with options is how much money we would get. If we go back to SPY, especially in SPY, if you buy this call and we go up a full dollar in SPY, you're going to make 50 cents. If you're lucky, you'll make 50 cents, right? You know what I mean? Like that's a full $1 move in SPY and you would maybe make 50 cents. And what I found for traders that were losing a lot in day trading is they would look at that and they'd say, but I held on for longer because I thought there would be more profit in it. I was expecting more money. I didn't see very much profit, so I stayed in thinking we're going to keep going. We've already moved $2 today, right? And it's been a sideways day. We haven't really had much of nothing. Your profit targets and options have to be quick. And if you're trading with the move, you're going to make even less money, right? So if it's one of these days and we're falling and you buy puts while it's red, you're not going to make as much as you think. Don't get me wrong, you'll make money, but it won't be as much as you think. Those options aren't going to monetize as well. If you can buy the puts while we're green, even on any of these pullbacks, it wouldn't be as good as buying puts, say, on a green day when we were running up. But getting options during the time when price is doing the other thing will help out with the pricing and the profit a lot. So in the trading world, if it was stock or futures or anything that didn't have decay and the Greeks and any of that multiplication to it, if it was just price and you could focus on getting in here and getting out there, your trades would have less doubt, less confusion. You would be more certain about whatever problem it is that's giving you grief. What usually seems to happen though is people add all the Greeks and the math and the complication and they say, I don't know why my trade is working. But when we go in and journal it and we find out that they tried to go short right there, yo, that wasn't a Greek problem, right? It didn't matter that you bought the wrong strike or that it was X amount of money in the money or out of the money or how far out in time. You tried to go short from the hole and it didn't work, right? That's just an analysis problem. That's a price problem. So when you're dealing with your intraday trades or your options trades, when you go to journal them, really differentiate between, yeah, I just straight up went the wrong way versus, yeah, I probably should have used a different strike or a different expiration or deeper in the money, deeper out of the money. Your win rate is connected to your risk and reward. I know that that can get a little nerdy, but your risk to reward ratio directly affects your win rate. Most newer traders have heard that you should risk one to make two, right? That's a pretty common logic. Risk one, make two. And it's not bad, don't get me wrong, but risking one to make two handicaps your win rate. You will lose more often because you're risking one to make two. If you try to risk one to make three, your losses are going to increase even more. And if you risk one to make four, risk one to make five, the higher that number, the more often you will lose. It's a math formula. It's just the way it works, right? Like gravity, it just is. And yet there are successful traders who can carry a really high win rate while also maintaining a really high risk to reward ratio. Those are the pros, right? They're the ones that are running uh, those trade offs where they trade for a year and they compare their notes and they have those big classic meetings. You have to be really picky to be that kind of trader. You're not going to get those kind of trades every single day, which is why they run those kind of events for the whole year so that they'll have time in that year to find setups that match their criteria. For the rest of us mortal people, right? Unlike the gods that are matching those numbers, you have to weigh out for yourself where your sweet spot is. And when you're trying to dial it all in options, there's a really handy way to do this. Lower your profit target a lot. If you're losing a lot right now, then forget risk to reward because you need all the wins you can get just to figure out if your strategy even works. So screw profit. Focus on getting wins. And if you want to win a lot, that's really easy. It's so easy, it's so simple. Lower your profit target. Get out at 10%. I know it sounds crazy. Do it anyways. Guess what? You'll win. All the time you'll win. I mean, you'll win 99% of the time because you have a very low profit target. Slowly increase your profit target. Go from 10% to 15, from 15 to 20. And every time you change it, take 10, 12, 15 trades, 20 trades. If you win with a high win rate in those 20 trades, bump it up again. Go to 25%, 30%, 40%. Sooner or later, you're going to get to a percentage where you start to lose. Not every single trade, but losses will start to show up. Now you know that you're starting to get into the edge of your average profit target. Bump it up a little further and check your win rate. When your wins drop below 50%, 50, you know you've gone too far. Stop there, maybe back it up a couple percentage points, and you should be somewhere around 50% profit, 60% profit with a 50% win rate. Because that would be the norm, right? That's Joe Schmo, the guy that sacks your groceries trying to trade 50-50. So you should be able to hit that. From there, That's when you start making adjustments, being more selective on the trades you take, analyzing the ones that worked versus the ones that didn't, trying to maximize momentum days and avoiding range days, all the little nuanced things. Because at that point, you can really start to dial in the money, right? But all of that just gets you to the win rate. I haven't even gotten into any ratios yet. If you're losing more often than you win, drop the number back. So if we were at 50 and you're running it for 20 trades and it's still good, leave it there. But if it starts to fall off, back it up some more. And this is a number that changes constantly. It's one of the reasons that I tell people that you should journal. Your numbers will give you the results of how are you doing and how is the market doing. You could do the exact same trade 100 days in a row and everything's fine, and then day 101 something changes. Maybe we got a new president. Maybe they started raising rates when they had been cutting rates, or vice versa, right? Maybe they start cutting when they had been raising, whatever it was. Maybe we got something that fundamentally changed in the world that radically altered the way the market moves. You didn't change, it did. But you need to know that something changed and it will show up in your numbers if you're keeping track of your numbers. Of course, if you're not keeping track of the numbers, then you won't notice. When I have a bad day, if I'm hot headed, say frustrated with somebody or aggravated about something, it shows in my trades. If I didn't get enough sleep, if I was out partying, whatever it is, it shows up in the trades. My risk reward is off, my profit is off. And if I know what it was, if I stay up till 3 in the morning binge watching Netflix and then my numbers are off tomorrow, at least I know. You're like, yeah, that's what I get. Stayed up too late. But what about when you don't know? Then it's just a really good heads up, like, hey man, something's wrong. My numbers are going to hell and I haven't changed. So something must have changed. It gives you a way to recognize it and call time out and start figuring out what the hell happened. So profit target is the easiest thing in the world that you can change to increase your win rate. The problem is you can't live there, right? We can't live at a 20% profit target because we haven't talked about loss yet, right? And the problem with loss is, and I see traders do this, they'll put the widest stop imaginable on there so that it doesn't get hit. And then they'll manually close the trade when they deem that it's no longer a good trade. I mean, that works. And if you are a skilled trader and you follow the rules, it'll work just fine. But if you're new and you don't want to eat the loss and you don't push the button, the loss just gets worse and worse and worse until it finally hits that exaggerated stop that you never wanted to hit in the first place. We can't risk 100 to make 10 over and over and over again and expect a good outcome, right? That's just, it just doesn't work. Sooner or later, you're going to get burned. And it happens to all of us, which is why you see traders do it right up until the day that they get burned. And then you don't see them do that again. The only thing in your control is the loss out of the entire trade. Before you get in, you don't know if it's going to work. You don't know how much profit you're going to get. But the one thing you know for a fact is how much you're willing to lose. And there's some gold to that, by the way. It's what I teach NASDAQ traders. The NASDAQ, if you're not familiar with it, is one of the fastest futures trading products that we can trade. This sucker moves. And if you watch the bid ask, it jumps 3 ticks or a point in the blink of an eye, no problem. Up, down, this thing is just all over the place. And to be able to trade it, you kind of need a wide stop. Kind of. You don't have to, but you got to be nimble on your feet to trade this thing because it moves. So what a lot of traders, when they do try to trade it, they just use a wide stop. Unfortunately, that gets you hit, right? You will get hit with those wide stops. And then what? Well, then you just ended up with a really big stop, right? So you got to teach people how to run it where they're not getting hit with those really big stops. And look, watch this thing move around sometime. If you haven't watched it before, that thing, and it's calm and boring today, right? Like we have nothing going on. So it's not really moving that much. But look at that thing at like 10 in the morning, 9:45. Ooh, it's jumping all over the place. So when it comes to trading, if loss is the one thing that you have control of, you could end up with a trade that gets a mediocre win, even a trade that just scratches flat and you don't lose, but you don't win. Any of those are preferred to taking a loss, but you can occasionally get an outsized win. And if your trading strategy is designed to get the occasional outsized win without ever taking an outsized loss, then you're in good shape. You got a way to expand on that and grow. You just have to make sure that you're never ever in a position to take a loss that is an outsized loss. Now, different traders approach this different ways. They'll use a hard stop that is put on as soon as they enter the trade using like bracket orders and things like that. That works. It doesn't mean that you can't go in and adjust the thing once it's on, but still, it puts it on. I'm going to log out and log into paper so that we can play around with options a little bit and I don't have to worry about losing money because I'm going to just be jumping in and out. I'm not going to try to target some tradable opportunity. So one thing I don't like about Thinkorswim is you have to log completely out and then log back in on paper, unless you go to the web. If you're using Thinkorswim web, you can jump from paper to live without ever having to log out. It's kind of nice, but for our purposes, it doesn't have what we want. So paper money down at the bottom. Heads up to anybody that you see me taking a trade. It's not live. I'm not risking anything. Don't do what I'm doing. This will give us a chance to just get in and get out and not worry about setups and profit and risk and all that. Now, as a day trader, I like to use the dome. It suits me. It's what I like. You don't need to do it this way, but I think you'll find it's comfortable once you get familiar with it. So that is the dome on the right. That's the active trader, as Thinkorswim likes to call it. We got SPY here. We just need an options contract. We're at the top of this range. Let's just go ahead and buy a put, right? So SPY, those are 0 days. Let's go out to next week. This is Monday. So I loaded that put. It's the 635 put for Monday. And I can see that it's trading at 312. Got the ask and the bid that's it's a little janky, right? Because they're bidding an ask down here and the last filled price is up here. If we keep rising, the put will get cheaper. I like those. Let's no, not sell. Let's get in here. What are you doing? Get out of there. I said not sell. Let's go to buy. Buy some puts. Now the thing is I didn't let that rest, but you can see your order here. And if I don't want it there, say I want it lower, let's get those puts cheaper. That would be higher up. That way I know I'm getting filled along the top of that range, right? And you see how I've got control of the option? What price do I want to fill in that option? I want the price to be right around where price is at this high. That way, I can preferably, hopefully, buy that put when price is still rising to the upside. I don't want to buy the put when we're falling. I want to buy it when we're rising, right? Let it run right up into my position and fill me there, and then we could fall. By using the dome, I have that control, right? I can see my position, I can move it around, and I can see that position on the chart while I'm doing it to see where it would be located at. Now, this isn't a bracket order, but we could have added that too, right? We could have added a bracket order like OCO or just a trigger with a bracket so that my stop would immediately be filled or be added to the trade as soon as I fill. Now I don't have to worry that I'm going to get greedy or get scared. It's just already there. Takes it out of my hands. That might be the solution for some of you who are refusing to take your profit or take your loss where you had planned to take it to begin with, right? It won't solve all your problems because you can still move it after it's on there, but it gets you moving in the right direction because it gets you thinking about your exit before you get in, which is what you should be doing in the first place, right? You want to have a clear eye on when am I getting to get out of this thing? All right, I'm filled, so I'm in. Now, if you're wondering how did I fill, well, this is options, right? It's not stock price. The value of that option dropped significantly enough that even though my order was up here for 298, suddenly the option was worth 298 while price was still right here and I got filled down here. That's what happened. It's not a perfect science. I wish it was. It'd make things a lot easier, but that's why I got filled. And now we're starting to fall. So, if I bought it for 298 and I can sell it for 318, then let's do a single. I don't want 10. I think the auto position is on. I gotta change that. But I could put my stop in already, right? That was my stop profit. I might as well just put it on and worry about changing things later. There's my stop profit. And I can scroll down here and put in a stop loss, right? Just like that. Yeah, I did 10. I left it. Um, I'm in with 10, so you know, there's where I can adjust it down to 1. But if I wanted to fade it out, we can do it that way too, right? So now I can fade the play with 3 there, another 3 there. You kind of get the idea. You got more control and you can see it on the chart. One of the things that I really struggled with when I was new to options is that you were in the options chain and price ain't in there. I mean, it can be, but for most of us, it's not set up that way. And then, you're trying to trade options when you can't even see the screen. You can't see the candles. This gives you that control where you can see what's going on and you get a better idea, right? You can see. Let's get rid of that chart. I don't really need that one. That's better. Get a little more room. I was feeling kind of scrunched up there. So the dome, that's a good question when it comes to, well, how far out in time should I go? It's not a set number in time. You want to be dynamic, right? It's about going in and looking at the options chain and asking which one of these dates right now is offering me the best opportunity. I'm going to set this at 15. And let's just talk about the 0 day for a moment. We got an hour and 15 minutes left in the day. And these things that are out of the money, they're trying really hard to keep it above zero. So they're playing around with the Greeks and they're trying to hold these things up out of the water. And they're just the worst choice completely. So we're going to leave those alone. Monday is not bad, or I mean, tomorrow's not bad. If we're scalping, if I'm going to get in, and get out like 8 to 10 cents later, these would be my choice. Why? Because they have the tightest bid ask spread and the strongest volume without being a 0 day. So they're my next choice out. And if I'm going to scalp 10 cent, 15 cent moves and take a lot of contracts, I would use this. But if I'm going to hold it for, 50 cents, maybe a dollar, maybe even hold it overnight into tomorrow if things look good, I wouldn't want these. I would go out a little bit farther like I did to at least Monday. That gave us the weekend of theta and see the dollar value difference between 635 and 635. And I can highlight it just to make it a little easier. We added days, even though it doesn't seem like it, because trading days we only added two, but actual days we added quite a bit. And yet look at the value difference. They're not that far off. Give yourself that, and what are you paying? 10 cents? Okay. I mean, I'll pay up 10 cents just to have a little buffer. I got theta buffer. The Greeks are going to slow down a little bit. It'll be a little more price dependent. I'm liking that. But the answer changes if you're going to go in the money, at the money, out of the money. So you have to play to your style. The options that are out of the money, we require significant changes in the Greeks and or they need to go in the money, right? But if it's way out there, then it's almost inconceivable that it would, right? The options that are in the money act very much like stock. The Greeks won't help them all that much, but for the movement in the underlying stock price, the options will gain and lose very much like stock will gain and lose. Not penny to penny, but pretty darn close. And then at the money gets some influence from the Greeks and then some influence from price. So you have to consider, what are you trading? How are you trading it? And then try to figure out which one of those three suits your needs. For me, for an example, I don't like to sit in it all day long, right? I want to get in, maybe hang on to it for 30 or 40 minutes at most, and then I'm going to get back out again. I'm definitely not scalping. The options that, if you can hold on to them long enough, if you think we're going to get a $10 move and you want to see that reflected in the Greeks and see it reflected in the price, then these out of the money options, they're fine. They'll do the job. But if you're looking for 75 cents, maybe $1, we're not going to change very many strikes. And that means you're not going to get delta applied. You're not going to get all the benefit of the Greeks. And these out of the money options, they're going to sorely disappoint you. One of the best ways that I can represent that is strike price shift differential. So let's highlight this 640. If I buy that 640 and we get a $1 move, what I bought for $1.57, I could unload for $1.97. So 40 cents. We got a $1 move in SPY and I made 40 cents. But if I buy this 633 and then we get a $1 move and I sell it, what I bought for 5.25, I can unload for $6. I made 75 cents here. I made 50 cents here. In that $1 move, the out of the money option will make less money. But if we did that same technique, that little strike price differential, and we went $5, the one in the money won't benefit as much as the one that was out of the money. So, when you're trying to figure out what expiration and what strike, you have to look inside and say, well, what kind of trader am I and what do I think I'm going to run today? And if you're buying at what is perceived to be the low of the day and you're going to run it back up, buying an out of the money option ain't really a bad idea, right? If it was, down here and you're thinking we could get back here, it's not a bad idea to get an out of the money option. It's crazy cheap and there's a lot of room, like a $4 move, $5 move. That out of the money option will monetize and it kept your risk down. But if you was going to get in at 634 and get out at a dollar later, probably wouldn't want that out of the money option. It won't pay you as much. And then for the expiration, you choose. I've done this. I even did it in a video that's on the Bullish Bears about monitoring the price of. I put in like 7 trades and I scattered those trades through different expirations and then moved price to see, what the outcome was. Discounting the 0 day, obviously, because it has its own metrics. Anything that was between 4, 5, 6, 7 days, the profit difference was minor at most, right? Like you could tell that there was a little bit of profit difference, not enough to make a difference. So what you want to do is go in and see, are they trading it? Like Mondays are usually kind of light, right? So today, looking at Monday, it doesn't look that bad, but it's not that good. On Friday, if I was looking at Monday, it would look a heck of a lot better. So when we do get to Monday, if you're looking out to the next Monday, it's not going to look that good. So look at the volume, the open interest. Are they hitting it hard? Is the implied vol giving you any edge? Kind of shop around because you're not looking to follow a checklist that says get in using this strike at this expiration this far out in time. Instead, you're looking around and asking what would be the better expiration at this point in this product this time. And you can get fast at it, which is what those 3 videos were about that I shared yesterday. You can do it slowly because we all have to start somewhere. You got to start slow, but you'd be surprised at how fast you can get because day trading you got to get in there and get it. You can get really fast so that you just pop in, you hit what you want, and you're in it and you go. Which, by the way, I mentioned price being in the options. You can get it to where you've got your trade grid up here so that you can see price. Here's a little trick to it: just stack them all. Right? Nobody wants to see that many charts, but stack them all. Let's do that. And then drag these things down to where they're just on top of each other. And now you've at least got this much so that you can see those two. You don't need the rest, right? I don't need the rest. Put a chart there, get rid of L2. And that's within the options chain. So I've got options down here and I've got price up there and I can just scroll back and forth. And the window is big enough that it actually has some value to it. Otherwise, you just end up with this tiny little window and it's like, well, that's janky. What am I going to do with that? This at least gives you a big window. You can see price. Of course, you could put the dome up there, right? You got the active trader. You could do it all from right here. You don't have to go, somewhere else. And that way you can keep your eye on the options and see price. Also on the days to expiration, I see people say, "Well, I'm just going to take a day trade," and then it goes against them, and they say, "Well, I was going to take a day trade, but now it's losing, so now I'm going to hold on to it." If your trade style gives you the okay to hang on for more days, then think about that when you go to get the trade. You're going to need those days. I don't trade that way, but it's not to say that it's not wrong. It's just not what I do. If I'm taking a day trade, then it's a day trade. I'm not hanging on to it. You can clearly define your profit and your loss before you get in, right? And that's what's recommended is to clearly identify, hey, how much can I make and how much can I lose? And then how much am I willing to risk, right? If I buy it for $5, obviously I can lose $5, right? But I don't have to lose 5. I can buy it for 5 and put a stop at 2 or 3, right? We're in control. And when it comes to those stops, I highly recommend that you don't put stops on the option itself, right? Like there's some rules to that, but if you remember when I got filled back here, that's going to keep driving me crazy. I might as well just put the chart there. When I was back here and my order was sitting way up here and I ended up getting filled like right here. Why? Because the options price changed, right? Price didn't have to move up there to finally hit me. The value of the option changed and it filled me here. Well, guys, the same thing can happen with a stop. So if I did have a stop on, say at that top blue line, we can be sitting right here and trigger that stop and get kicked out of the trade. Why? Because the options value wicked, it changed for a brief moment and wicked you out, even though price hasn't done anything that would make you want to get out of the trade. So if you're using a stop in options, and there are times when I say that's a really good idea, generally speaking, you shouldn't need the stop. My exception to that rule is the SPX because that thing has the fastest rate of change to options prices that I've ever seen in my life. Nothing moves faster in price than the SPX options. But for anything else, I mean, look how fast the price of this option is moving. It's really slow. So if it's slow, you can manage it on your own, right? Like you got control of this. Um, the SPX, however, that darn thing moves, man. Just always use a stop. And if you're selling the open, for goodness sakes, do not use a stop. Selling the open is really bad for stops. Manage it manually. Profit targets or profit stops, those are different. Let's just go ahead and load. I guess I don't have any saved. Let's build one since this is where I keep wanting to go anyways. I like to put the active trader in its own window. It helps. We're going to put a symbol in just to get something to show up here. Then we can turn on the active trader and turn off the chart. If you leave this blank at the top, you can choose the options tab here and then put in the name you want. Choose what you want. We've got that 635, I believe. Yep, there's our 635. And now we're good. And then, of course, you can just rearrange these for whatever you want. Put your bracket orders up there and all that. 15? My goodness, no. That way we're not jumping back to that one all the time. All right. So another thing about day trading options If you keep your profit targets down and you win more often, then you can slowly start to increase that profit target, right? We talked about this earlier. So, how do we know how much I could get? We use that strike price shift differential. But you got to get used to doing the math and you got to be fast at it, right? Can't be fiddling around in here. There is a calculator on the side, so that can help. And then there is the little note taker. Both of those are really valuable tools, right? I use that scratch pad, man, all the time. That thing is so valuable. But try not to use the calculator if you don't need it, right? Just round instead. Rounding will get the job done because it's not about being perfect science, you know? So just get used to going in and, taking two blocks of strikes. They don't have to be side by side, but it makes it easier for what we're doing. And you can just look at those two numbers and see if I buy it at this and I sell it at that, what's it worth? Now, remember, we're trying to split the mid, so you won't actually buy it on the ask, and hopefully you won't sell it on the bid either. You try to split the mid. That would fill for 9 cents. This would fill for 71 cents, right? You kind of get the idea. But if you're rounding, then it's 410 and 470. That's 60 cents. So $1 move, 60 cents. And if it's going to go against us, then if I bought it at 10 and sold it at 60, then that's 50 cents. I'll lose 50 if I'm wrong. I'll make 60 if I'm right. It's almost a one-to-one trade. But I can see that before I get in to better make the decision. Do I want that strike? Would it be better if I chose a different strike? We don't know, right? We can look up the chain, down the chain, and then we can go farther out in time to ask that question. Because, guys, the Greeks, it moves through time. Shoot, that's the wrong one. It moves through time and it moves through price, right? So the Greeks are like this wave, but it's a 3D wave, almost like DNA strand, right? So when you're trying to figure out what strike and what expiration, depending on how the Greeks are going, that 563 may be good 3 days out, and yet the 570 may be better 5 days out. You won't know until you look, right? And it's always in flux, it's always changing, just like waves in the ocean. They're headed up and down, you get big crests, big valleys. So if you can come in quick and you've already got your pinpoint, you know where you want to look. You're going to be looking in the money because you want something that's going to move more like stock. You want something out of the money because you're trying to take a trade that's going to go from the high a day to the low a day, or you want something at the money because you want a little bit of the Greeks and you want a little bit of price. You already got your starting point. Then you're just shopping around for which expiration. And usually it's a 3 day window, right? I like to go for at least four. So I would go 4, 5, 6. But if this was Tuesday, I might be looking at Friday, Monday, Tuesday, right? Like the days would change, but it's 3 or 4 days. I'm not looking to go a month out because you don't need to. I've proven that to myself enough. If you're day trading options in the indexes, the Qs, SPY, you don't need to go a full month out. But if it's, just some Joe Schmo, whatever, then you really want to shop around. 8 days out, I just picked JOBY. It doesn't have a lot of volume here in the front end, 8 days out. And yet that volume is better than the monthly is. So if I was day trading JOBY, I wouldn't want to go a month out. These options are trash. I'd rather be in the front here, even though it's close to expiration. Yeah, it's a day trade. These 8 day are the better choice. So when you go to trade something, shop around. Look at the expirations, look at the volume, the bid ask, how many strikes there are. And it helps if you write out what your plan is, right? Like I mentioned in the money, out of the money, and at the money. You can have a plan for all three of those. Like if we're at the low of the day and we're getting ready to turn and you think we can run back to the high of day, that's a really good time to use an out of the money option. That's when I like to do it. You might find that you have some other time that you also like. So then you have a rule that says, I'm trying to take the entire move so I can use out of the money options for that. But if it's a range day like today and you're trying to run it from, high to low, the range really isn't all that big. You would probably want to use at the money or in the money so that it moves more like stock and you make more money in a smaller move, right? Because this isn't going to give you as much. And you'll need to be able to get profit in a 50-cent move, not even 50-cent move. The in the money option would pay you better in this scenario. The at the money would be cheaper and would give you a breakout opportunity. But yeah, when it comes to using the dome, by the way, it can really help you target where others are at. So I'm still in those puts and I paid 298 for them. Right now those puts are trading at 289. So I'm down on my puts. And I can see that from here. I don't have to bring up my P&L, right? I don't have to go to the trade tab and look at it. That's my entry. And this is currently where those puts are priced at. And they're actively getting traded, right? Like a bunch of people are buying puts right there. For all we know, they sold them up here and they're buying to close. We don't know what they're buying those puts for, right? We just know that they're trying to buy some puts down here and that a lot more people are selling puts down here. Well, maybe they're like me. Maybe they're long and they're saying, screw it, I'm out. And they're selling down here. We don't know, right? You can also see where those options were heavily traded. Now, this is just one strike, right? It's the one 635 put, but I can see that a lot of puts were traded up here when it was round number $4 and then some here, right? So we can, it's a volume profile. So it's just telling you where trades happened. Let's zoom out on that a little bit. Maybe it'll start to take the shape of a bell curve. Too far. So there's today's sweet spot, 330-ish. Janky. Paper is janky, man. Now quit resetting. Stay. See, we could turn on time and sales. We can watch those getting filled or not because they're disappearing off of here, but we don't know if they're disappearing because they're getting filled or if they're just pulling and stacking. But if you had time and sales on and level two on, then you could see, those trades and whether or not they're actually getting filled there. You have more information about the option that you're trading. As a day trader, I found this to be a lot more valuable, right? Because now I have more information about that strike that I'm trading. I know some people actually chart the option itself. I'm not a big fan of this, but this is what it would look like, right? Let's put that put in here. What the heck is that? There we go. And of course, if you put an option in there, it's going to load the theoretical price. So you always have to go in and turn that off. But anyways, there's our put as it's being traded today. And since I bought it, it's just been, I bought it like back here, right? That we had that little pop up and I sold some and now it's just been selling off. That put is losing value. We can visually see the put. I know traders who will do this. They'll put moving averages on it and VWAP and all that stuff as if it was real price. I get the logic behind it, but I don't subscribe to the theory, right? Like price is price. It will behave at VWAP. It will behave at Bollinger Bands and moving averages, even if it's the price of the option. I get that, but I'm not a fan. If you're trying this on the Qs or SPY, yeah, it'll probably work. You try that stuff on JOBY or some, I don't know, Apple, whatever, probably not going to enjoy the outcome. But it does give you the visual of what's happening to the value of that option, which can really help you grasp the logic of, the option's value changing, even though price didn't move in the underlying. So now I got to stop on. I should have checked to see what my total position is. What have we filled today? I bought three, or excuse me, I bought 10. I've closed three, and then I closed three more. So I'm still in four. And I've got one working order. All right. So let's change that number to two. I got in on a two. We'll get out on a two. That's a 50-cent loss. And then the final stop will be there. And at any time, you can just grab them, even right on the chart. Say this one, I want it to be right on the low down here. So I can just grab it, drag it down to the low right there. I mean, that's nice, guys. I mean, you got to admit, if you haven't tried this as a day trader, give it a shot. I think it's going to help you really change your approach. And of course, Lucian's got videos for using the dome with Thinkorswim on our YouTube. They're not on the website. So if you go to YouTube and type in something like Bullish Bears Thinkorswim playlist, you should find every video made by the Bullish Bears that talks about how to use Thinkorswim. A lot of those are mine, setting up like charts and colors and the buttons and all that kind of stuff. But also a lot from Lucian talking about things like the dome, setting up the bracket orders, the OCO orders, which is really nice. Getting these to be exactly what you want. The idea behind this is you have to figure out why you're losing. Holding too long is the big one. Expecting more out of profit. And then when it doesn't come, we stay in too long and then we get hurt. That's usually the biggest one. But just straight out using the wrong expiration, like trying 0-day stuff, it's a bad idea in the afternoon because they decay so fast. It's not to say you can't do it, it's just you shouldn't do it. should just leave that alone until you got experience. Speaking of, I'll share this with you guys. It's not law, but it's what I was taught, and it served me well. When I started day trading, I was told don't trade the SPX. Leave it alone. You're not allowed to trade it because you haven't earned the right to trade it. That's what I was told. So of course, it begs the question, well, who's going to give me permission to do anything? I am. When you feel like you're ready to trade this, then you've earned it and you go in and trade it. But you should treat this completely separate than anything else. The SPX is its own beast and it needs to be treated accordingly. So, take that as you will. I didn't trade it for probably the first 2 years that I was a trader. I completely avoided it. And I think I'm a better person for it, but to each their own. When it comes to day trading, though, the SPY, this is the best thing you could ever trade. One, to learn how to day trade for options, right? Leaving futures aside, because we all know futures are awesome for day trading. If you're going to day trade options, you can't find anything better than this. It's got the tightest bid ask spread out of anything out there, which means you can just market order in and out in every trade. You shouldn't want to do that, right? Like you should want to try to fight the bid and fight the ask and get the mid and get the best price. But the thing is, you don't have to. You can just market order and call it good because it's usually a penny wide unless you're really far out in time, right? Like the farther out I go, I start to get a wider bid ask, 3 or 4 pennies, maybe even 10 pennies, and it's just unacceptable. Now you have to use a limit order. But if you're 5 or less days, a lot of times it's maybe 1 penny difference. So what? Just hit the button, get filled. That way you're not trying to pinch a penny and price runs away from you before you get filled. And you're like, ah, dang it, I missed my trade. Why? Because I was fiddling around trying to save a dollar and I missed it. I've lost hundreds. No, that's not the right word. I've missed the opportunity to make hundreds of dollars because I did that, right? Trying to get a really good price and then it runs away without you and you don't get filled at all. In SPY, theoretically, that should never happen because you can just market order in and market order out. Best practices would say you should probably work the order, right? Like that's the appropriate thing to do. Once you get good, you can. The other reason that this is a really good product to day trade is that, all of the analysis that we do, all the tools that we use, it all feeds back to SPY. So if you're using tick, CTIck, weighted AD, advanced decline, UVol, DVol, all that stuff, it focuses on SPY. All the GEX and DEX and TREX that's out there, that's all going to focus on SPY. So it's good for that. And it's mean reverting, unlike equities. And it has options that expire every day so that those other 0 day traders will come in and move the options market even when price ain't moving, right? Which is good for us. So when it comes to day trading, especially while you're learning, you can't go wrong trading on in the SPY. The Qs ain't bad, don't get me wrong. And every year they're getting better and better. But SPY would always be my first choice. And if you want a little checklist on places to trade, you could just stay 5 days out. You know what I mean? Like there's nothing wrong with that. You could just always stay 5 days out. I don't like that answer. I think it's better to shop around and see what the best options are today. But 5 days should get you going, with a little bit of a line in the sand. So strike price shift differential, if the math is screwing with you, there is a button up here that says spread that you can change to vertical. Notice now it's combining the strikes, right? We would not want to trade this way, but it really helps with the numbers so that we can see, what would we get if, and then we can look up and down the options chain this way. You just have to move further now, right? Kind of ugly though. So if I trade this one, I'd make about 55 cents in a $1 move. If I trade this one, I'll make about 60 cents in a $1 move. That's the differential doing the work for you. But it just, to me, it has missing information. I like having all the pieces in this one, but I wanted to throw it out there. I don't know how well that would work on something with bigger strikes, but still you could do it that way. I like to leave it this way so I can just see it for myself. Now, none of that covered, should I buy here? Should I sell here? Are we going to break out on the day? Are we going to challenge the high of the week? It just covers simple things that I know a lot of traders struggle with, which is, how much should I expect this option to make? What kind of stop should I use? What strike should I pick? What expiration should I use? Because that's where a lot of people get hung up. So hopefully you guys are good on that, right? You've got a good strike analysis now, and uh, a reasonably comfortable area of execution. How far out in time to go? Then using the dome, you can better visualize your trade to manage your stops and your. Let's turn the auto on so we don't keep getting confirmations. That's better. So I just tightened the stop up so it would either kick me out or get going, one or the other. So what else you guys want to talk about today? I'll give you guys a moment to think about that while we take a look at what's happening out there in the market. The Mag 7 complex has broke back down inside the breakout point. That is certainly an indication of weakness. And the stochastics has come back inside, not yet below the 50 mark, but certainly demonstrating some weakness. If we look at it on the weekly, though, the stochastics still isn't below 80, and the breakout point changed to this. So on the weekly, we're still good, but on the daily, we're under pressure. Right now, under pressure, I mean, look at this run. Right, we were back inside, even back here, and it all worked out. So, you know, let let that be a warning. Just because we've got a little weakness on the daily doesn't mean that we're done, because this is still showing that we're still really strong. On the growth versus value, or the growth rotation that we were seeing, we broke down through the drama level 222, got the stochastics back below 50, and this isn't the same chart. This is just a different version. We would need to put it on a weekly to see if we have the same dynamic. No, the stochastic still hasn't fallen down yet. So on the daily, or in the shorter term, yeah, we've got some issues with the Mag 7, but the broader trend is still intact. Kind of like how Spot Gamma was laying it out the last 2 weeks. They kept saying, watch out for a short term pullback, but they're still long term bullish until. And we don't have the until yet. Growth versus value moving to the upside says that the Mag 7 is underperforming, but we already knew that. And we're seeing the weakness here. But we had the same thing back here, right? When it jerked to the upside and we kind of sold off for a little bit. And back here too, where we just paused. So this move to the upside that we're seeing now, yeah, it's warning us, but not giving short signals. Same thing here. We had a sharp move up here, didn't do much. Same thing here, sharp move up, didn't do anything. A sharper move here, and we're feeling it, but it's not a short signal, just a warning, like an alarm bell. This actually held more weight for me when I was looking at it yesterday. There was still some candle left yesterday. We're just doji now. These are monthly candles, and we are back inside last month's range. That's the first negative. And we are back to our open, and that's the second negative. We gapped down to open there to begin with, and then we were a little weak and we rallied. Now we fell back down again, and that's not good. So this complex ratio chart is like a tech graph. I absolutely can cover the charts that I use in my analysis in the morning prep. Absolutely. And I'll add to it the work that I've done over the years on this same topic. This is my website. I am not a web developer. In fact, I absolutely suck at it. So it's not fancy. But if you click the blog posts and we go back to some of the first posts that were made, I covered the morning briefing. Now there's 3 parts to this, and the links to the other parts are in the link to this one. I've also done a PDF and a couple of videos over the years. So I shared the link in the chat. It goes through everything that I like to talk about: economic events, Europe being open, Asia closed, possible earnings on the day, different websites that I use to see if other markets are open around the world. Talks about famous bankers like Jamie Dimon and Jane Fraser. You should know those names, right? You should know their Twitter accounts and see what they're talking about. Because when they talk at earnings, oh man, it matters, right? That's part of day trading right there. They really know who the influencers are. And the big fund managers like Buffett and Kathy Woods, Bill Ackman, Ryan Cohen, Carl Icahn, you want to know what those guys are doing. Not so you can piggyback their trades either, right? Like that's not the point. But if Carl Icahn or Ryan Icahn comes out and says something like hey, I just dumped all my Verizon and I'm putting out short signals. When you want to know, you know what I mean? Like it's gonna matter. It'll move the market. And if he did it on something really big, say like Nvidia, it would dump the market. if he did something like that. So you want to know what those guys are doing, especially when they come out speaking at earnings times. Then there's always big events like the Amazon Prime Day, Cyber Mondays, Black Fridays. Those kind of events stand out. And so do investor day conferences, like when Apple has its big investor day. You know that you want to know when those events are, and they cycle. They just come back around again and again. Then the economic events, PPI, CPI, non-farm payrolls. We go through those, right? So this write up, I'm just kind of scrolling through it, goes through all of those things down into my watch list, talks about breadth, using Mag 7, setting up charts. Now, when it comes to the charts point, I shared every one of my charts. I did it for TradingView as much as possible and for Thinkorswim. And then I talk about using levels and how to even make those levels with these two blog posts here, measuring things, part 1 and part 2. Using CTA charts, developing your trading plan for the day, your thesis. So that one blog post covers all of that. Then we get into top down charting, going out to like the monthly, the weekly, the daily. So every day when I share that link in the chat, let's just do that. So
Homeowners
everybody can see
insurance
it.
and property protection are essential components.
So let's scroll back to what I share every morning. All right, I share this link. And right here is the replay, right? So when we click that, we'll get today's stream, which doesn't really matter. That wasn't my goal. But if we go in there, there's the website, some recommended channels like the FedWatch tool, Finance Juice, Options Omega, those some day trading options videos that I shared yesterday, the watch list columns that I use, and then the charts that I use. There's my 15-minute, my 10-day 30, like all of my charts are in there. And the charts have the indicators already on it. So when you import my chart, you immediately have the indicators because they're already on the chart. That way you can go through every one of the charts on your own because you already have them. You don't need to wait for me to go through them. And that's the whole goal of the morning briefing, right? Is to get people to the point where they don't need me to do it. They can do it on their own. So this first page is all about the background, kind of a big picture level of the things that we look at every day in the briefing to figure out what the market's even supposed to do today. It ties in with day trading futures and economic events, intraday trading, ADR. Like a lot of these blog posts all tie back to the morning briefing, but especially the economic events. So I cover some websites that I use. These are all free sites, doesn't cost you anything. Talks about the different events like CPI, PPI, non-farm payrolls, FOMC. Yeah, absolutely. All of those tools that I use can be applied to the SPX and the SPY. They can be applied to anything really. So let me log out of this paper account and get back on my real Thinkorswim. Hey, it's always better to ask. All right. The numbers will be different if you use it on different things, right? Like this. It's really noisy, ugly indicator down here. It starts at midnight, which for the futures is fantastic, right? Because they're open all night long. And I came up with this a long time ago. I was trying to figure out, how do you know that something's off when you get up in the morning, right? Like things would surprise me when I was a new trader. I'd get up in the morning and I wouldn't know, for an example, that Europe was closed because of a holiday or something like that. Right. And then I'd come in and I'm trying to trade at like 4 in the morning and price just ain't acting the way it's supposed to act. I'm like, what the, why, what's wrong with me? What's wrong with my strategy? It ain't working. But it wasn't me, right? There would be something like Europe was closed or Asia didn't open last night or something like that. So the idea that I had at the time was, why not monitor the overnight volume? And all this is doing is just adding up every trade that came in, whether it was one contract, 100 contracts, just how much volume was traded last night. And after looking at it for a couple of years, I got a pretty good idea of what the average volume is for the ES every day. If you was to apply that to Apple, I have no idea what Apple trades every morning in the pre-market. You know what I mean? I have no idea. But if you're going to trade it, you'd probably want to know that answer, especially, if you're doing pre-market work. So you got to kind of know the average of whatever it is that you're trading. Now, I did over time add an average line because I had people ask, well, can't you just put an average line in there? So, yep, there's the red line. That would be your average line. But as you can see, it's a slow mover. It's been working its way down since that spike back there. Looks like it needs to be updated a little bit too. Seems a little janky, but you can put an average in it. That way you can bring up something you've never traded, like say JOBY in the pre-market, and see if its average volume is there or not. Because all we're looking for is participation. Now, if you're on SPY and the Qs, those are 24-hour products. So it'll work anyways, right? Like that shouldn't be a problem. We can still have to be concerned with what is average for SPY, but if you're going to trade SPY or the Qs, then you would just put in the work to figure out what average is. And, rough estimate, it looks like average is around 0.3 to 0.5. It stands out when it turns purple, for sure. That was purple in the pre-market, not in the RTH. So the tools will work on whatever you put it on, but the numbers are going to be a little different. You'll have to figure out some of it on that aspect. And then I have the spot gamma lines, this volatility trigger, zero gamma, call wall, put wall. Those are for only the indexes. So those won't work on Apple or Microsoft or something like that. But I share mine in the mornings so that if we did go to Apple or something, I have to load today's on this computer. So give me a second. I shared it in the chat this morning. It's the document that says OEC TOS levels August 21st. Open up that document, copy all the language, paste it in here. Now, this indicator is only going to work on my watch list of like 30 names. So, of course, if it's some Joe Schmo out of the money junk trash company I've never heard of, it's not going to show up here. But if you do the Mag 7 or commodities, oil, that sort of stuff, it should show you a level. So there's Apple's levels for the day. They don't look like spot gammas exactly, but it's the multi-level and the one standard deviation moves for the day. So it gets it done. And then the 7-day expected move. If we stay on SPY or the Qs, then you'll have both mine and spot gammas. So here is SPY, and we can see volatility trigger, put wall, but we can also see my indicator on there too. So you get the best of both worlds. The other piece of this chart, we're still on that first chart, right? Let's remove some of these things. We don't need the VWAP. We just talked about spot gamma and my indicator, the cog lines, morning briefing, and what we end up with is that. So these lines are daily moving averages. This white line that ran up and crossed the 10 right there, it's the 3-day moving average. Well, it's this white line right there. It's the same one, right? So I just took the 3-day and it put it in here. And then this blue line is the 10-day, and that's this blue one here. Green is the 20-day, and that's that there. Then this big one that's in white, that's the 3-week, and this is the 10-week. Now, those are noisy, especially with the tags on them. I don't normally have the tags on there when it's just me, but when I'm live streaming, I have them on there. Without the bubbles, it's a less noisy. But I found that new traders don't do the top down as much. They don't go out to the higher time frame because they think, well, I'm just day trading. So having those daily and weekly moving averages on your intraday chart helps remind you that they are out there. Once you get comfortable with that logic, then you can just turn the damn thing off, right? Because I don't like it. It's too much noise. It's not on my intraday chart. My trading chart is blank. But for analysis, that's not bad. couple of lines. So all of that is the first chart that I show in the morning briefing. Then the ADRs. ADR just means average daily range. Mine is set at 21 days. So it goes to a daily chart and it looks at the last market month, which is 20 days. And it says, hey, on a day to day basis, how far did we actually move? Up or down doesn't matter. Just between one close to the next, what's the average daily move in the market over the last month? Because we tend to do what we have been doing, right? That's just the way things work in the market. So at any given time, we can bring up any chart, any product, and the distance between those two red lines is the average daily move. Right now, the ES has a daily move of 1%. So that's half of a percent this way, half of a percent that way, and the distance between them is 1%. If we're behaving normally, we'll move within those two red lines. If we get bullish, we'll move that distance in one single direction. We'll go all the way to yellow, up, or all the way to yellow, down, like we did yesterday. When we ran yesterday, we went all the way to yellow. So average daily range. What I'm looking for here in the pre-market is how far have we already gone? Because while we're sleeping, markets can do a lot. If we've already reached the edge and it's still in the pre-market, my expectations that today's actually going to go somewhere diminishes greatly, right? We've already gone. I missed the move. The best I can hope for is that we're going to retrace and go to the other side by the end of the day. So here was an example. We had a sharp reversal into the close, and then in the overnight, we ran all the way up to the first half. So by the time we came in and did the morning briefing, we were already falling away from it. Of course, we went to the other side and plus some by the end of the day, but so it sets you up in the morning for an idea of what's the norm and have we already made it? Put it in terms that are a little more simple to understand. If you run a mile every day, that's your norm. You get up, you put on your shoes, out the door you go, you run a mile. Today's just any other day. No big deal. And then you go out and you run 6 miles. Well, you put in a little extra that day. You want to know what markets are doing before you start trading them. Have they already put in the extra that day? Because a mile might be pretty easy for you to do unless you just did 10 and then someone says, hey, you want to run a mile with me? No, I just did 10. I don't want to run another one with you. I'm cooked. If the market's already got their work done before we even start trading, it's likely that we won't get anything more out of it. On those days where it does keep going like this, we knew we were in an extraordinary environment because we'd already made the entire move and it just kept on going anyways. So that we can say, well, how bad is it? We just doubled our expected move on the day. It's very bullish, it's very bearish, it's very whatever. It's aggressive, it's violent, and it's continuing. Now, the other part of this chart is what the number is. I look at it every day. So when our average daily move was 2%, I knew that 2% was high. And when we faded down and it was 1.8, and then it was 1.6, and then we were at 1.2, I could see it declining because I looked at it every day. You guys are seeing it now at 1%. You're thinking, okay, well, that's what it is. Yeah, well, before COVID, it was like 0.6 was our average daily move. We weren't even averaging, 0.75%. So every market has an average and an average of the average. And you have to get a feel for that over time. the good thing is no matter what you put in there, it'll still give you that ADR and the visual to better understand, are we behaving normally or not? I just brought up Apple, and for the most part, Apple is doing what it's supposed to do. It's pretty much staying inside the lines because if it behaves normally, that's what it's supposed to do. And when it doesn't and it goes in a single direction, then it makes it to the yellow line. And then, of course, there's, those big blowout wow days. This chart today, uh, catch the other piece, the market maker move. Now, this platform is Thinkorswim, and it was made by Tom Sosnoff way back in the day. And he hired a lot of really great traders to help him build it. And there are a couple of mathematicians, some quants. So they're all in there throwing out ideas, telling the engineers what they wanted built into it. And they had very big clients, like TD Ameritrade was a client back then. They didn't own it back then, right? So they had big clients, and those clients were telling them what they wanted in it too. So that's why Thinkorswim has so many pieces built into it and redundant pieces. You can get to the same answer like 5 different ways on Thinkorswim. One of the things that they put into it is something that they made up. They just literally made it up. It's called the market maker move. Now, back in the day, he sold it to TD Ameritrade, and TD Ameritrade had like 9 or 10 articles about this one topic, which is why I know so much about the market maker move, because there used to be a lot of articles out there. Now there's one. If you know how to use the internet go back, then I would recommend you use the go back and find what used to be called the ticker tape, published by TD Ameritrade. And they have like 9 articles all talking about this market maker move. I'm going to explain what it is and all of that, but what they never covered is that you can use it for futures too, right? Like it's like they never even thought of it. So what this thing is doing is it's looking at 0-day options, or the equivalent of, right? Apple doesn't have 0-day today, but it has front end options. And in that front end, what it's checking to see is if the implied volatility average in the front is greater than the next expiration out. It's not supposed to be. So if it is, we get a market maker move. So in theory, if you can see the options data on any platform, you can check to see if you have a market maker move. You don't need Thinkorswim to do it. Thinkorswim is just the only platform out there that will actually tell you that you have a market maker move because it's theirs. They made it. Schwab owns it now, so technically it's Schwab's, but you know what I mean? Like IBKR ain't going to do it because they're not going to, put somebody else's tool on their platform. Webull, Robinhood, whoever. So what happens is these numbers on the side are the average of all of the options that are being traded. Here's the, let's put the number on here. We want the implied volatility of these options strikes. And if we was to average all of the out of the money options, only the out of money on puts and calls, and add them all together, average it out, it would come to 39.44. And that number will change if a lot of trading activity happens in here. So if they come in and they start hammering these out of the money options with a lot of volume and they're doing it swiftly, the IV on just those strikes will rise, and that'll jack up the implied vol average. So if they come in hedging in the front end, we get that. Take that over to futures. If you see them coming in, at 8 o'clock in the morning with a market maker move, they're scared about something because they don't hedge for free like you and I do. It costs them money, and they're always hedged. What we're talking about is extra hedge. and it's all cost, and they won't spend that money unless they're scared about something. So I like to have that label. That way, if we do see a market maker move, we understand why we see it. If it's, non-farm payrolls, CPI, PPI, well, duh. You know what I mean? Like, it's not a surprise we got a hedge happening. But what about those days where there's no economic events scheduled? Everybody's just waiting on the market to open. It's a calm, normal every day, and then boom, there's a market maker move up there. Why? What's going on? Why are they hedging? Maybe we get to find the answer, maybe not, but at least we would know, hey, they're suddenly hedging about something. They're scared and they're spending money, and it warns us, to start looking for the cause. Sometimes I've looked and never found a cause, by the way. You don't always get the answer, but at least you get the warning. And that market maker move can be on anything as long as it has options. So Microsoft, for an example, has a market maker move. So did Apple, by the way. But now they are trading in the front end. We don't necessarily know what they're doing, but we know that they are trading in the front end and it jacked up their number. One way that you can use that number is by expected move. So this number on the side is your plus and minus for how many days there are. This option will expire tomorrow, and price can go $6.28 higher or lower before this option expires. Right? So this number is a expected move number. When we have a market maker move, we add those two numbers together. 6 plus 4 is 10, 25 and 25, that's $10.50 from our current price. Microsoft could go to 515 or to 494. I guess that's brain fart. That's pretty close. It's like 493 and a half, whatever. But we got a plus and minus there because we take that and add it to that. Now we know how far this thing could move, so that if we were trying to play mean reversion or just wanted to do some butterflies or maybe even just put an iron condor on this thing, we know where the edges are supposed to be. And if it runs those 14 points, we can try to short it there by the end of the week, right? Say like tomorrow we pop up 14 points, short that sucker. Why? Because it already moved its expected move. So market maker move. It is a warning of risk and hedging. And we look for it every day in the morning briefing. These are floor pivots, just your normal everyday run of the mill floor pivots. I just took and added a channel to them. There is something called the CPR, Central Pivot Range. Here is the formula for your floor pivots. It's like high plus low divided by blah, blah, blah. It's just math, right? That's how we get the floor pivot, and it's how we get the S and R lines. But if we want the channels, then we need that formula. So I just took this formula and threw it into Thinkorswim, and I built channels around the floor pivots. So it's just a fancy floor pivot. The pivot that I'm using is one for the week. That's why this line stretches all the way across, and then one for each day of the week. During the analysis on this chart, I also turn on the SNRs, but I don't leave them on because it's just so noisy. It's way too much noise. There's the SNRs for the day, right? R123, S123. And that's really good to look at in the pre-market too, to kind of ask the same question as the ADRs. How far could we move? And how far did we already move? For an example, back here, we had already made R1 in the middle of the night and we had left it behind and was falling back. I mean, that was not a guaranteed short, right? But I was more happy with the short opportunities knowing that we rejected that R1 back there and that it was likely that we could go to S1 by the end of the day. And that's what we did. There's actually a strategy that says we could have gone to S2, but we didn't get it. Right? R1 for S2 or S1 for R2. Central pivot ranges, pivot points, just your daily run of the mill floor pivots. These pivots are very much what um, average price is, but it's not average price. It's very much that. If we look at what happened yesterday and where we're going to open today, I know traders who will use that pivot, right? So here's yesterday's floor pivot. I know traders who will use that. I'm not a big fan, but I mean, they wouldn't do it if it didn't have value. I've got enough pivots. I don't need any more. But just like your CPR lines or your point of controls, you can carry forward the previous day's floor pivot. Here's an example. I guess we didn't actually hit it. I was thinking we did. Where we ran up and hit the previous day's floor pivot, but we didn't hit it. Still, it's another level that you can lay out. And on the day, it's a good balance for where's the mid of price today. So if we open far away from the mid, it's more likely that we're going to mean revert and go back to it. Back here, for an example, we opened really far above the mid. Here's the mid down here. Nah, that's the weekly. Never mind. Find a better example. Now we kind of opened far away here, but we just went farther away. So it is a gauge. The far away thing, I tend to use that more on the weekly too, by the way. On Mondays when we open up, one of the first things I'm looking at is, hey, how far away from that weekly are we? And I know, like, I think it was 2 months ago, we opened a long ways on Monday from that weekly floor pivot. And that was one of the things I covered that Monday in the live stream was like, oh, hey, we're a long ways away from that thing. Watch out. I think it was this week right there. So in the live stream from Monday, June 30th, I'm going to have to go back and watch that replay. I pretty sure I warned in that stream that here's the weekly floor pivot all the way down here. And we were opening, well, in the stream, we were like right here. That's a long ways away from the weekly pivot to start the week. And it's likely that we have a hard time going any higher from there. We could go higher, but it'd be hard to do because we're already so far away, you know? Well, the same logic applies on a day to day basis. Where did we open and where is today's floor pivot? Above us, below us, by how far? And if we're too far away from it, we're likely going to try to go back to it. And then this volume profile. So this is a weekly profile. Every one of these is 1 week. That gives me a snapshot of the previous week's trading activity in a grid format so that like we could turn on a weekly candle, but then we're blind, right? Because all we have is open, high, low, close on that weekly candle. We can't see anything else. This helps me see what happened for the whole week and when the new week began. Then when I'm looking back, I can see, hey, do we have any overlapping areas of influence? Like back here, we had those multiple point of controls, and it became a problem when we ran into it. And then it tried to help us out when we fell into it. So I like to use this, look for shallow areas that we might fall through, or areas of support that might try to hold us up. And doesn't take long on this one because it's just a quick glance. We look left, try to find stacked areas of points of control or big footprint areas or shallow areas. Mark those levels out as needed, and then we're done with this one. This is a 10-day, 30-minute chart with the volume profile in green and the TPO profile in blue. Those are two different profiles. The one in green is looking at volume. The one in blue is looking at trades. We can have 5 trades, each with one contract, then we'd have 5 volume. But we can have 5 trades, each with 100 contracts. Now we'd have 500 volume, 5 trades. Um, normally, yeah, my Wednesdays lately have been a mess, but it's Thursday. So I'm good. I don't mind stopping because it has been 2 hours and we can pick back up tomorrow. That would be good too, just so the recording don't get too long. And we're at a good spot. We can just pick up here and it'll give you guys time to look at the website and the stuff that I had already wrote too and get all the indicators. It'll give you guys time to think of questions too. All right. Yeah, I'm good with that if you guys are. Let's just wrap it up here and we'll pick up tomorrow at 2. Yep. Everybody have a good night.